Most people are staring at the screen, watching silver hover at $79, thinking that's the market. But here's the harsh truth. The number is almost irrelevant. What truly matters is physical availability, how much silver you can actually get your hands on. And the reality is grim. Consider the industrial giants, the ones who actually consume silver by the billions of ounces. Tesla alone depends on it for EV battery contacts, solar panel paste, and high-tech electronics. When Elon Musk commented publicly that this is not good regarding silver availability, he wasn't worried about the price. He was worried about production continuity. A halted assembly line isn't a Wall Street problem, it's a Tesla problem. If they can't secure silver, cars don't roll off the line. Panels don't generate electricity. Rockets don't launch. This is where industrial demand becomes the true market driver, not speculative paper trades. The emotional punch is clear. While retail investors focus on price swings, the real game is supply security. Musk's warning isn't a casual observation, it's a flashing red light for anyone dependent on silver. The $79 spot price is a mirage, a comforting number created by paper contracts in New York and London. While actual inventories are being drained faster than they can be replaced, industrial users cannot substitute silver. Physics doesn't negotiate electrical conductivity, thermal efficiency, and optical reflectivity make silver irreplaceable in high-performance applications. Copper or aluminum might be cheaper, but they fail where silver succeeds. The gap between the paper price and the reality of supply is widening every day, and those who recognize it early gain a critical advantage. By the end of this section, viewers are no longer focused on charts. They are awake to the structural deficit lurking behind the ticker. The narrative shifts. The market is no longer a casino for speculators. It is a war over scarce physical metal, and industrial demand is calling the shots. This realization sets the stage for understanding the structural supply deficit that is about to collide with growing industrial demand, forcing a dramatic repricing of silver in the real world. The financial game of paper silver is over. 4 years, speculators, hedge funds, and banks treated silver like a trading chip, bought, sold, and leveraged endlessly. But now, the game has changed. The real battle is no longer about profit, it's about survival. Industrial users, the companies that cannot function without silver, are taking control, and their actions are rewriting the rules of the market. Tesla, Samsung, Apple, they cannot simply switch to copper or aluminum without paying a performance penalty. Silver is unique in its conductivity. It transmits electricity better than any other metal, dissipates heat more efficiently, and reflects light with unmatched precision. In EV solar panels, AI processors, and high-efficiency electronics, silver isn't optional, it's essential. Substituting even a fraction reduces performance, efficiency, and reliability. Production halts if supply fails. Unlike financial traders, these industrial giants must secure the metal, not just a paper claim. This urgency has triggered an industrial panic. Orders that were previously just in time are now aggressive stockpiles. Tesla signals a shortage. Samsung doubles its refinery orders. Apple corners storage and secure vaults. Suddenly, silver isn't moving in pennies, it moves in tens of dollars per ounce with every bulk purchase. The market is no longer elastic. Every purchase by a real user consumes physical metal, leaving less for everyone else. The arbitrage that used to balance prices globally is broken. Shanghai premiums soar, New York and London paper markets lag, and the illusion of unlimited supply shatters. The emotional beat here is urgent. If you're watching this, you're witnessing a psychological and physical shift in the market. The industrial sector now dictates silver's trajectory. Retail traders, paper speculators, and ETFs are sidelined. The industrial war room has taken over, and it is ruthless. This is empowerment through awareness. Recognizing the shift early allows you to align with the real drivers of value, not the fiction on your screen. The panic doesn't occur in isolation. Industrial hoarding collides with Chinese supply controls and new export licensing, creating a bottleneck that threatens to accelerate the crisis. Understanding these controls is critical. The next section will expose how geopolitical maneuvering and resource nationalism amplify scarcity and set the stage for a market reset. On January 1st, 2026, China changed the rules of the silver game, and the consequences are seismic. The new export license framework is not a minor bureaucratic tweak. It is a strategic blockade to ship silver abroad. Companies must now meet an 80-ton minimum annual production requirement and demonstrate $30 million in credit capacity. For smaller refiners, private miners, and secondary processors, this effectively shuts the door. The market is no longer open, it is gated. The emotional impact is immediate, outrage, but also clarity. This is not an accident. It is resource strategy on a national scale. China is capturing refined silver for domestic industrial use EV batteries, solar panels, electronics, locking it inside its borders. Western manufacturers, accustomed to sourcing silver cheaply on the open market, now face a stark reality. Supply is no longer guaranteed. Every ounce that stays in China is one less ounce for global production, and the ripple effects are dramatic. The divide between paper markets and real supply. Shanghai premiums rise sharply while New York and London paper quotes lag. The bifurcation of prices is now visible to anyone watching closely. The paper price may appear stable, but physical silver is tight, hoarded, and escalating in Asia. Traders and speculators who ignore this disconnect risk being blindsided when the gap triggers arbitrage pressures or forced deliveries. This is systemic awareness in action. The market is no longer just about trading contracts, it is about controlling actual metal. China's policies illustrate a simple, harsh truth. Industrial sovereignty beats speculative illusion. The rules favor those who produce, store, and consume silver efficiently, leaving financial intermediaries scrambling. Understanding China's blockade is crucial, but it is only part of the story. The real question is how these controls intersect with global demand. With industrial consumption surging and Western access restricted, the math of supply-demand deficits becomes unavoidable. The next section will quantify this imbalance, revealing the scale of scarcity that drives prices higher and exposes the fragility of paper claims. The numbers are stark. In 2025, global silver demand reached 1.24 billion ounces, while mine production and recycling combined barely hit 1.01 billion ounces. That leaves a structural deficit of roughly 230 to 250 million ounces, a gap that cannot be filled by mere market optimism or paper contracts. For years, the silver market relied on above-ground stockpiles to plug this shortfall. Inventories in vaults, ETFs, and secondary markets acted like a financial safety net, allowing prices to stay artificially tame. But these reserves are rapidly draining. Imagine a bathtub. Demand is the running faucet, production is the slow drain refill, and the bathtub itself represents global stockpiles. The water is almost gone. Soon, there will be nothing left to patch the deficit. Industrial demand is now shockingly, unlike gold, which has investment and jewelry components, silver's physical properties, unmatched electrical and thermal conductivity, make substitution nearly impossible. In EVs, solar panels, smartphones, and industrial machinery, companies cannot just switch to copper or aluminum without losing efficiency and performance. Each ounce of silver demanded by industry is non-negotiable, creating a relentless upward pressure on consumption versus supply. This structural shortage is more than a statistical quirk. It is a systemic reality. The market has shifted from speculation to survival. Every decision by Tesla, Samsung, Apple, and other industrial giants now has a direct impact on global availability. Price signals, while important, are secondary to actual physical control of metal. The emotional effect is clear: shock, realization, and a sense of urgency. Investors and viewers begin to understand that the familiar paper price, the number flashing on screens, does not reflect the real-world scarcity. The physical market is under siege, and every ounce consumed today is an ounce unavailable tomorrow. With above-ground stocks nearly gone and industrial demand dominating, the paper market faces extreme stress. The next section will explore how leverage, overallocation, and fractional claims amplify risk, turning what looks like stable trading into a potential paper-silver crisis. The illusion is staggering. For every physical ounce of silver in a vault, there are 356 paper claims floating in the financial system. Futures contracts, unallocated accounts, ETFs all promise ownership without delivering the metal. On paper, the market appears deep and liquid. In reality, it is a house of cards. Picture this. One lone silver coin sits in a secure vault. Outside, 356 entities, hedge funds, speculators, industrial buyers claim it as theirs. Each believes the system will honor their ownership. But if industrial giants suddenly demand physical delivery, the illusion collapses. The coin cannot satisfy 356 promises. Panic would ripple through exchanges, brokers, and banks. This is not a hypothetical. It's built into the market structure. Industrial demand has become non-negotiable, and as Tesla, Samsung, or Apple moves to secure their supply, the leverage ratio becomes terrifyingly relevant. What was once paper speculation now meets physical reality, and the gap is catastrophic. Prices could spike tenfold or more, instantly punishing any position that assumed infinite liquidity. The Federal Reserve has already glimpsed this danger. In a rarely disclosed intervention, the Fed injected $17 billion via emergency repos to temporarily stabilize leveraged positions. These are stopgaps, not solutions. They patch the cracks in a market where derivatives mask real scarcity, and every repo merely delays the inevitable reckoning. The emotional tone is urgency and outrage. Viewers should feel the weight of a system designed to pretend abundance while the underlying metal is vanishing. This isn't just about investors losing money. It's about industrial production grinding to a halt, supply chains breaking, and systemic trust in markets eroding overnight. With paper leverage at unprecedented levels, the next section will examine systemic banking risk, exploring how a silver shock could cascade through financial institutions, forcing central banks and regulators to confront the consequences of decades of fractional ownership and overleveraged trading. Behind the scenes, the silver crisis is testing the very foundations of the banking system. Bullion banks, once perceived as untouchable, are exposed to enormous risk due to their role in facilitating paper silver trades. A single default, one bank unable to honor delivery, could trigger a domino effect. Clearinghouses freeze, counterparties panic, and suddenly what seemed like abstract numbers on screens becomes a systemic threat. The Federal Reserve has already acted, though quietly. Emergency liquidity injections, effectively QE without a name, are shoring up vulnerable institutions. These interventions temporarily cap losses, prevent immediate bankruptcies, and stabilize the market. But the cure comes with a hidden cost: inflation. By printing money to back leveraged silver positions, the Fed fuels a self-reinforcing cycle. Higher monetary supply weakens the dollar, industrial buyers scramble for physical silver as a hedge, and prices climb further. The tension is palpable. The system is caught between two impossible realities. On one side, banks cannot fulfill the paper promises without massive exposure. On the other, halting interventions could ignite panic across broader financial markets. Investors and industrial players alike watch, aware that a misstep could ripple through equities, commodities, and global credit markets. This is a moment of revelation. The crisis is no longer just about silver. It exposes structural fragility in fractional reserve frameworks, excessive derivatives, and the illusion of liquidity. Every emergency repo, every unannounced Fed operation underscores a simple truth: the financial system was never designed to handle a mass demand for physical delivery of scarce resources. Yet this fragility also creates opportunity. As central banks backstop losses, inflation rises, and traditional safe haven assets like silver become increasingly valuable. The interplay between monetary expansion, banking, stress, and industrial demand sets the stage for unprecedented price movements, turning silver from a passive investment into a critical strategic asset. The next section will widen the lens, exploring the global geopolitical dimension, how nations, trade policies, and export controls interact with silver scarcity. Will reveal that this is not merely a market crisis. It is a geopolitical chessboard where industrial survival, national interests, and monetary policy collide. The silver crisis is no longer just a market story. It has become a geopolitical chess. U.S. allies watch nervously as the fragility of the banking system is exposed. While the BRICS nations and China quietly recalibrate their industrial strategies, the silver shortage is more than an economic inconvenience. It is a strategic lever in the global industrial hierarchy. China, in particular, wields its dominance like a weapon, controlling roughly 60 to 70% of refined silver processing. It can dictate who accesses the metal, under what conditions, and at what price. Export licenses, domestic hoarding, and preferential supply for strategic industries are not just business decisions, they are national security maneuvers. Meanwhile, countries pushing dollarization see silver as a hedge, a way to insulate themselves from Western monetary instability. The East-West dynamic is clear. While the US and Europe scramble to cover industrial shortfalls, China and allied nations accumulate leverage. Silver becomes more than a commodity. It is a strategic asset, a bargaining chip, and a shield against systemic financial exposure. Corporations reliant on physical silver, from electronics to EVs, are now forced to navigate geopolitics as much as supply chains. For viewers, the takeaway is empowering. Understanding who controls silver and why is not optional. It is essential for anticipating industrial pricing, investment opportunities, and systemic risks. Those who grasp this new industrial order can position themselves strategically, while those who ignore it remain vulnerable to sudden shocks in supply, price, and policy. With geopolitical forces reshaping access, the final focus turns to industrial floor pricing and actionable investor strategies, revealing how scarcity and strategic control translate directly into the market's next moves. Forget paper, silver, and speculative chatter. The market now revolves around industrial necessity. With global demand at 1.24 billion ounces and supply barely over 1 billion, the physical deficit is undeniable. Corporations like Tesla, Samsung, and Apple cannot substitute silver without sacrificing efficiency, performance, or compliance. When physics dictates demand, the price becomes inelastic, and that's why $100 per ounce is no longer a prediction. It's the conservative industrial floor. Consider the mechanics. Each ounce consumed in EVs, solar panels, and electronics represents a hard, non-negotiable cost. Above-ground stockpiles are nearly depleted, and China's strategic controls further tighten supply. Any corporate scramble for guaranteed delivery immediately pushes prices higher. $100 isn't speculative, it's the baseline required for production to continue without disruption. For retail investors, the message is stark. Waiting for a cheap pullback is likely a losing strategy. Industrial demand will absorb available silver long before prices retreat, leaving latecomers sidelined. The opportunity lies in recognizing scarcity as certainty, positioning assets in advance of broader market realization. Confidence comes from clarity, the new industrial order, supply deficits, and geopolitical leverage collectively set a floor that is both practical and inevitable. Those who understand the mechanics act decisively, while those who ignore them risk being reactive instead of proactive. With the industrial floor established, the final takeaway crystallizes how to align investment strategy with physical scarcity, geopolitical trends, and systemic financial dynamics, turning insight into action before the market catches up. The silver story is no longer theoretical, it's an industrial and systemic reality, and your approach must reflect that. Think like the corporations that cannot function without silver. Prioritize physical ownership over paper claims. ETFs, futures, and unallocated accounts may offer convenience, but they expose you to the same leverage risk that threatens the banking system. Start with allocation ranges. For most investors, 10 to 25% of liquid assets in physical silver aligns with industrial scarcity without overexposure. Focus on deliverable silver in secure vaults rather than promises on screens. Track the right indicators. The Shanghai Premium, vault inventory reports, and repo market spikes reveal when industrial demand and systemic stress intersect. These signals act as your early warning system, hinting at impending price moves and shortages. Act with urgency, but with strategy. Industrial buyers aren't waiting for a bargain, they secure what they need and drive prices naturally higher. Retail investors who mirror this mindset position themselves alongside the market's real drivers, rather than chasing illusions. Every ounce purchased today is insurance against future scarcity, and potentially a front row seat to the next major price discovery. The call to action is clear. Don't wait for a collapse to react. Paper silver may hold value on screens, but only physical silver guarantees participation in the industrial endgame. Secure your position, understand the market mechanics, and align your strategy with supply-demand realities. The systemic shift is underway. Be part of it, not a bystander.